Hello and welcome back to Principles of Accounting 1. I'm still your host, Dr. B. We just got done with a wonderful conversation on accounts receivable, notes receivable, all kinds of receivables. Now I'd like to continue our discussion on the asset side of the balance sheet, talking about property, plant, and equipment, also known as plant assets. We'll also talk about things like natural resources. These are things like minerals, and lumber and etc. that comes naturally from the earth. And we'll also discuss intangible assets. These will be things like copyrights, patents, things that we cannot physically touch, but are also considered assets, like copyrights and patents and things like that. Okay, property, plant, and equipment. It's not as easy as it sounds. We got to record the cost of property, plant, and equipment. As you know, the cost is not just the purchase price. Yeah, of course, we purchased the property, plant, and equipment, but there's more to it. The property, it's the cost of building the building, or the plant. It's the cost of building the building. The property, it's the cost of the land itself, but it's also the cost of maintaining the land. For the building, it's not just the cost of the constructing the building, it's also the cost of putting in the parking lot, lighting, insurance, yada yada. The equipment, it's not just the cost of purchasing the equipment, it's also the cost of getting the equipment shipped to you, getting the equipment installed, the insurance, etc. It's a lot of those additional costs. All of those costs together equal the total cost for property, plant, and equipment. So plant assets, we call these property, plant, and equipment. They're tangible in nature. We use them in day-to-day operations of the business, and they help us to generate revenue. That's the future benefit. Right? They help us to generate revenue. So when we purchase property, plant, and equipment, that's part of our acquisition cost. We also have, in addition to the purchase price, we have all of the additional costs it takes to get the property, plant, or equipment to us. We call these acquisition costs. Over time, and I believe we've talked about this briefly probably last week. Over time, the property, plant, and equipment, mostly the plant and the equipment, lose value over time. They become less useful. And as they become less useful, we account for this thing called depreciation. We use them for a period of time. They lose their usefulness because they start to wear out and wear down. And ultimately, they start to nickel and dime us. And then eventually, at the end of their useful life, we dispose of the plant and the equipment. So let's talk about acquisition costs first. It's the purchase price, but also includes things like insuring it, getting it ready for use, so installing the equipment, uh, getting it to us, etc. The acquisition cost is not just the purchase price. It includes the cost of getting the property, plant, and equipment ready for use. Okay, so there's a lot of costs involved there. But it's getting the property, plant, and equipment ready for use plus the purchase price. So for machinery and equipment, this would mean the purchase price, installing the equipment, assembling it, testing it, any taxes involved with the purchase of it, transportation charges to get it from wherever it was made to us, the customer, insurance while it's in transit, etc. These are all acquisition costs for machinery and equipment. For buildings, also known as plant, yes. Buildings, also known as plant. The acquisition costs are things like the purchase price or construction costs, brokerage fees, taxes, attorney's fees, titling fees, etc. These are all acquisition costs for buildings. For land, for acquiring a lot, for example, that's part of the acquisition cost for land. But we also have land improvements, like putting in a parking lot, driveways, fences, walkways, shrubs, trees, lighting systems, etc. These are all acquisition costs for land. Additional land acquisition costs would be real estate commissions, title and search transfer fees, surveying fees, property taxes, title insurance premiums. Now, we talked briefly, very briefly, about depreciation. I think it was last week. And one thing I mentioned is land never depreciates. Property never depreciates. Plant and equipment do. The building itself and any equipment depreciate over time. They lose their usefulness. Physical land never loses its usefulness. I can knock the building down and put a new one up. The dirt is still dirt. Okay? The dirt is still dirt. It does not depreciate. The land itself doesn't depreciate. It doesn't lose its value. Okay? The land is the land. The building, yeah, that uses usefulness. Equipment, yeah, that loses its usefulness. But the land never depreciates. Only buildings and equipment depreciate. So when I purchase a building or land or equipment, it's the purchase price plus all the extra stuff I got to pay in order to get it to me. That is the acquisition cost. The total cost of combined purchases for things like land and buildings is allocated based on their fair value. We call this relative fair market value. And use example for CarMax. CarMax, what they typically do is they'll purchase an existing building on land. Okay, existing building on land. They'll purchase an existing building, and it's on a piece of land. They paid $90,000 cash to acquire a group of items consisting of some land and the building that is on the land. The land was appraised at $40,000. The building was appraised at $60,000. This means we will have an allocated cost of $90,000. So $60,000 and $40,000. 60 plus 40 is 100, not 90. So you're saying, well, Dr. B, you said that they used $90,000 in cash, not 100. 60,000 for the building, 40,000 for land. It's 100,000 in appraised value. The word appraisal is relative term. It's not always fair market value, but it's usually close. That's where the appraisal comes from. So what the company does is they, what we call, apportion the relative costs. They take the amount used to acquire each, the total amount used to acquire both the building and the land, 90,000. And they multiply that by the percentage of the total. If the appraised building and land together equal $100,000, we find the percentage of the total by taking the appraised value of each and dividing by 100,000. For the building, we take the appraised value of 60,000 and divide by 100,000 to get 60%. And for the land, we take the 40,000 and divide by 100 to get 40%. To find the apportioned cost, we take the $90,000 used to acquire both the building and the land. We multiply that by the percentage of the total. So in this example for the building, 90,000 times 60% is 54,000. For the land, 90,000 times 40% is 36,000. Together, they equal $90,000. Because remember, in this transaction, we used the company used $90,000 to acquire a building and some land that the building is on. Call this a lump sum purchase. Over time, buildings and equipment lose their useful life. We call this depreciation. Depreciation is the process of allocating the cost of the plant asset to expense in the accounting period, benefiting it from its use. What I mean by that is, to account for the loss of useful life, we expense it through what we call depreciation. As you know, expenses show up on the income statement. The assets are found on the balance sheet. So we cost them out over the accounting periods where the assets are being used. Call this depreciation. There are three amounts you need to know when we depreciate. First, of course, is its cost, and that's the acquisition cost of the asset. So acquisition cost, number one, we need to know this. Number two, we need to know the salvage value. The salvage value is how much the asset is worth at the end of its useful life. And third is called the useful life. The useful life is how long we expect the asset to be used in the company. How long we expect to use the asset in the company. Useful life is typically predetermined by the IRS, the Internal Revenue Service. The Internal Revenue Service creates what's called a Maker's Report, MACRS report. And this report tells us the average useful life for plant and equipment. And it breaks it out. And it's for like everything. You'll see cars on there. You'll see buildings on there, specific structures. Gives an estimate of how long things will last. And we use that for tax purposes. We use that for depreciation. But these three things we need to know for each asset. And as we depreciate each asset, we select one of three methods of depreciating the asset. One is called the straight line method. The straight line method, we depreciate the same amount every year over the useful life. That's called straight line until it reaches a value of 0. For units of production, we depreciate the asset based on the number of units produced each year. And the third method, we take what's called the double declining balance. It's basically the straight line method times 2, and I'll explain that. We'll go through each of these three methods. So in our example, we'll say it's a forklift. We have a forklift. And this forklift cost us $10,000. It has a salvage value of $1,000. Salvage value, again, is how much it will be worth at the end of its useful life, the scrap metal, right? Giving us depreciable cost of $9,000, meaning I can depreciate $9,000 worth. We were told the forklift has a useful life of 5 years. And we can create a total of 36,000 units with this forklift. Using the straight line method, we take $9,000, which is the depreciable cost, divided by 5 years. At the end of each year, we'll have a depreciation expense for the forklift of $1,800. So it's cost minus salvage value, which is $9,000, divided by useful life, 5 years. Gives us a depreciation of $1,800 per year for a total of 5 years. So what we do at the end of each year is we make an adjusting entry. The adjusting entry is we debit depreciation expense, $1,800, and we credit accumulated depreciation for that specific forklift, $1,800. On the left-hand side, we see it's the same amount each year for the period of 5 years. On the right-hand side, we see what's happening to the total book value on the balance sheet for the forklift. It goes down by $1,800 every year for a total of 5 years. The total value is $10,000. That's the cost, right? Goes down by $1,800 every year for 5 years. At the end of the 5th year, we should be left with the salvage value, $1,000. And that's what this shows us. This is a summary of it. Looking at the straight line depreciation schedule, we can see that over the 5 years we depreciated $9,000 up to $10,000 asset, meaning we have a remaining balance of $1,000 for book value. That's the salvage value. The salvage value does not get depreciated. Remember, salvage value is like saying it's the scrap value. What's it worth at the end of its useful life? This is typically predetermined. If the forklift depreciates $1,800 per year for 5 years, that means we have a depreciation rate of 20%. How did we get 20%, you might ask? We take the $1,800 and we can divide that by the 9,000, right? That gives us the 20%. So that's the first method. It's called straight line method. Any questions on straight line method for depreciation? Hopefully it's straightforward. You see what I did there? It's a bad joke. All right. Cool, thank you. Now let's talk about what's called the units of production method. There's a couple of steps. It's really 2 steps. Step 1, we find the depreciation per unit. Depreciation per unit. To find that, we take the cost, $10,000 in our example, minus the salvage value, 1,000, giving us a total of 9,000, divided by the total units of production. I forget what the number that was. It 36,000? Does that sound right? Yeah, 36,000, using our example. So 9,000. Okay. So I take $9,000 divided by 36,000 units, gets me 25 cents per unit of depreciation. Step 2, I take my depreciation per unit, 25 cents, times the number of units produced in the period, in the year. Okay. That gets me my depreciation expense. So at the end of each year, I look at how many units I produced. Usually the first year we estimate. So let's assume that we produced 7,000 units during the first year. So at 25 cents per unit, I produced 7,000 units. That gives me $1,750. So the formula, cost, 10,000, minus salvage value, 1,000, 9,000, divided by the 36,000 units. It's 25 cents per unit. Step 2, 25 cents per unit times number of units produced during the period, during the year. 7,000 units, that's $1,750. I do that every year for the 5 years. Now we know that each year it's probably not going to be the same. I produced 7,000 units the first year. The next year I produced 8,000, then 9,000, then 7,000, and then 5,000. Okay. You get my 36,000. It has to equal 36,000 because that's the number of units for the useful life. To find the depreciation expense, I take the number of units times depreciation per unit, 25 cents, equals the depreciation expense for that year. I add all those up to get $9,000 total depreciation expense. It has to equal 9,000 because it's the cost minus salvage value. At the end of year 5, I should be left with $1,000 book value because it's the salvage value. So that's the units of production. Any questions on units of production? Makes sense, right? Okay. Cool, cool. All right. Moving on to double declining balance. As I mentioned earlier, it's kind of like multiplying the straight line method by 2, right? It's 3 steps. Very, very easy to figure out. So we take the straight line rate, which is 20%. We'll multiply that by 2. That's how we find double declining balance, right? So it's 3 steps. First, we've got to figure out, how do we find straight line rate? Well, we take 100% divided by useful life. 100% divided by useful life, in this example 5 years, is 20%. Very straightforward. The second step, we take the straight line rate, multiply that by 2 to find the double declining balance rate. 2 times 20% is 40. In step 3, we got to find the depreciation expense for the first year. We take the double declining balance rate, 40%, times the beginning period book value. Beginning period book value is 10,000. It hasn't depreciated in that first year yet. We're trying to find that amount. Take 40% times 10,000, that's $4,000. So if it depreciated $4,000 in the first year, to find year 2, I take the beginning year book value, 6,000. Why 6,000? 10,000 minus the depreciation from that first year of 4 gives us 6,000 remaining book value. 6,000 times 40% equals $2,400 depreciation expense for the second year. I take 6,000 minus the 2,400 to get 3,600. 3,600 times 40%, 1,440 is the depreciation expense for the third year, so forth and so on, until I reach end of year 5, which should give me a remaining balance, total depreciation expense of 9,000 when you add them all up. And a remaining book value of $1,000, which is the salvage value. And that's how double declining balance works. If I compare the 3 methods side by side, straight line method, units of production, double declining balance, I can see the differences from year to year. The total is always going to be the same, regardless of what method you use. The difference, of course, is based on the yearly amounts. Now, straight line method is the most commonly used because it's the easiest. Makes sense, of course, straight line method, easy. Units of production, not so common. About 5% of companies use it. Double declining balance, only 4% use that. And some companies might use a different method. There's a lot of other methods out there, but these are the 3 most common. Oftentimes, companies will select one or the other based off of taxes. If a company does really well and they don't want to pay a whole lot of taxes when they first get this machine into use, they might use double declining balance method. So the real reason, the non-textbook reason why companies might select one or the other is because of taxes. So for tax reporting purposes, corporations use the maker's report for tax purposes. Helps to also determine the useful life. This depreciation method also provides write-off for asset costs in order to stimulate new investment. So again, companies select certain methods for tax reasons. Sometimes, well, actually, a lot of the time, a company might purchase a piece of machinery or equipment in the middle of the year. So when that happens, or at some time during the year, okay, when that happens, we need to account for partial year. So if the company purchased a piece of machinery on October 8th, that means I got to account for all of October, November, and December. That's my first year, is only 3 months. Okay, so I still need to apply the same method, but the difference is the first year is 3 months. Yeah, and so when that happens, I need to figure out its usage for those 3 months. So 10,000 minus 1,000 is 9,000. That's my depreciable cost divided by 5 years. And I multiply that entire part by 3 over 12. 3 over 12 is the 3 months out of the year. So for that first year, the depreciation expense is going to be $450. Over time, there may be changes to depreciation. And the reason for that is sometimes the salvage value might actually be different than what we predicted. And sometimes the machine might last longer than what we predicted. So depreciation really is more of an estimate than anything else. And that estimate might change over time, based off of changes in salvage value or changes in useful life. Here's a great example. So our forklift that we have, right? Uh, we assume that at the beginning of the asset's third year, the book value is $6,400. That's the cost of 10,000 minus $3,600 in depreciated accumulation. At that time, we determine that there's a change in its useful life in the remaining 4 years, and that there was a change in the salvage value downward from 1,000 to 400. When those kinds of changes happen, we need to revise this based off of the revised salvage value and the revised useful life. So at the end of year 3, we have a book value of $6,400 minus $400, which is the new salvage value, divided by 4 years useful life, which is its new useful life, giving it a depreciation expense of $1,500 per year. So in other words, when these changes happen, we just simply adjust. We just simply adjust based off of our revised salvage and useful life values. Sometimes there might be a loss involved. And that loss stems from a piece of machinery not working effectively. Yeah. Losses come, there's a couple different reasons why an asset might be impaired. It's not working properly because of XYZ defects, whatever. So we need to account for that difference in fair value. So when there's a decline in the fair value, we need to write down the asset in its fair value. And to do that, we debit an account called impairment loss, which is a contra account to the asset. And we credit accumulated depreciation expense for that piece of machinery. Any questions on depreciation? Pretty straightforward, mostly. I'm sure there'll be questions later. That's usually a relatively complex subject. Okay. Now let's talk about capital expenditures. We know what revenue is. Revenue is sales. And we collect revenue from our customers. That's sales. Capital expenditures, that's different. Capital expenditures is the use of cash for the purchase of assets, property, plant, and equipment, or the use of cash to improve property, plant, and equipment. Those are what we call capital expenditures. They're usually very large, and they happen over time. So, to talk about the differences between the two, revenue, that's cash we receive from our customers from sales. They do not increase useful life or anything like that. It's just cash we receive from sales. Yeah. With that revenue, we pay our normal expenses. The expenses are recorded during the accounting period. They're recorded on the income statement as expenses, and they have no effect on assets, really. Capital expenditures, these are either the purchase of property, plant, and equipment, or it could be used for extraordinary repairs on equipment to extend the useful life. And these are things that are recorded on the balance sheet. One of those I mentioned is called extraordinary repairs. Let's say that our forklift breaks down at the end of year 2. Okay, the engine starts to fail. Now, if I replace that engine on the forklift, it will extend its useful life. Yeah, because I'll be able to use it longer. That's called an extraordinary repair. I'm sorry. That's called an extraordinary repair. Extraordinary repair. Extraordinary repair is a major overhaul or a partial replacement of an asset, like replacing the engine on a forklift. It extends its useful life. That's called an extraordinary repair. An ordinary repair is simply I change the oil on the forklift. I do regular repairs and maintenance. Small expenses. All that stuff gets recorded on the income statement as expenses. Ordinary repairs do. Extraordinary repairs, that's considered a capital expenditure and is recorded on the balance sheet. So, for example, for the year, our forklift needed new tires, oil changes, belt replacements, etc. These are ordinary repairs. All we do is we debit repairs expense, which is a regular expense item on the balance sheet, and we credit cash when we pay for those repairs. If I needed a new transmission on the forklift, that's an extraordinary repair. I would debit the forklift account under my assets, my machinery dash forklift. Debit that $1,800. Now credit cash $1,800 because I'm extending the useful life of the asset. Now, at the end of an asset's useful life, we usually dispose of it. Disposal can represent two things. One is either I'm actually throwing it out, no longer using it, it's not worth anything. That's one part of disposal. Or disposal could be I'm removing it from my books. I'm still going to use it, but I'm just going to expense it out. Yeah, at the end of its useful life. Because we know the forklift probably is going to last longer than 5 years. I'm sure that it will. At the end of its useful life, that doesn't necessarily mean that it no longer works. It'll still work, I just can't depreciate it anymore. And when that happens, I dispose of it. I remove it from my balance sheet. And I simply expense everything out thereafter. So the disposal plan assets is the update. We update the depreciation to the date of the disposal. To dispose of something or remove it from the book, two methods. One is we record the cash we received for it or paid for it. If I sell it or whatever, and I remove the accumulated depreciation that way. The other method is if I sell it, I can record the gain or a loss and remove the asset that way. So, really, a couple ways of doing it. By discarding the plan asset, if I receive cash by selling it, if the cash is greater than the book value, then it's a gain. If it's less than the book value, then it's a loss. If the cash I receive is the same as the book value, it's neither a gain or a loss. Anytime we receive cash, we debit cash. The credit would be the asset that we're removing. If the asset has been fully depreciated, meaning I've depreciated the full $9,000, I have salvage value of $1,000, then my salvage value gets recorded. If I get rid of it before the end of its useful life, then I have to adjust the remaining depreciation. Let's say it's fully depreciated. I debit accumulated depreciation and I credit the asset. And this removes the asset from our balance sheet. If it has not yet fully depreciated, then we make the adjusting entry. We debit depreciation expense, accumulated and credit accumulated depreciation. That brings the full depreciation up to the current date. Then I record the removal of the asset. Debit the full amount of accumulated depreciation, and then I credit either a loss or a gain on the disposal of the asset, and then I credit equipment. If I sell the asset at its book value, I first, of course, make the adjustment on depreciation, debit depreciation expense, credit accumulated depreciation. And then I record the sale. Debit cash, debit accumulated depreciation expense to remove the asset from the books, and credit the equipment to remove the asset from the books. If I sell the asset above book value, that's great. That means there's a gain on the asset. Debit depreciation expense, credit accumulated depreciation to get it up to its current date. Then I debit cash, Debit accumulated depreciation. Credit a gain on the disposal of the asset and credit the asset. Record the gain on the sale of the asset and remove it from its books. If I sell the asset below book value, try not to do that. Debit depreciation expense, credit accumulated depreciation to get it up to its current date. Debit cash, debit the loss on the asset. Debit accumulated depreciation, credit the equipment. This part's going to lead us into the one of the last parts we're going to discuss today, and that's on natural resources. Now, earlier we had said that land does not depreciate, and that's true. Land does not depreciate. It does not go down in value. However, some natural resources deplete. What we mean by that is some companies are in business to turn natural resources into raw materials. For example, oil companies drill for oil. Oil is not infinite. Eventually it will run out. The well will run dry. Okay? Once the well runs dry, it's called depleted. It's empty. Another example. Rare earth minerals are mined. Once the mine no longer yields any rare earth minerals, the mine is depleted. Some companies are in business to chop down trees to turn them into lumber. Deforestation. If the company runs out of forest to chop down, the forest is depleted. No more wood. Yeah. These are just some examples. So natural resources, they need to be accounted for as well for the company. The cost is charged to depletion expense over periods in which the companies operate. They extract natural environment parts and reported the cost minus accumulated depletion. It works very similar to depreciation. Of course, examples are oil, coal, gold, etc. The list goes on. So here's an example. We have a mineral deposit estimated at 250,000 tons available of ore, iron ore, and it's purchased for 500,000. Expected salvage value is going to be 0. So 500,000 divided by the number of units, 250,000 tons. That gives us a depletion per unit of $2 per ton. So the depletion expense is $2 per ton times the number of units extracted during the period. So $2 times 85,000 tons within that first year equals $170,000 of depletion expense during that first year. So it's very similar to the units of production or units of depreciation method. Very similar. So to record that transaction, we debit depletion expense and we credit accumulated depletion. And on the balance sheet, it would show the mineral deposit, which is the purchase price, 500,000, minus accumulated depreciation, depletion, giving the balance sheet balance for mineral deposit of $330,000. And at the end of the year, if the mineral deposit is sold at the end of the year or remains unsold at the end of the year, we debit depletion expense, debit inventory, and credit accumulated depletion. We know that there are certain plant assets that are required to extract natural resources, and all of those are also recorded as separate accounts on the balance sheet and are depreciated accordingly. And intangible assets. Intangible assets are assets that cannot be physically touched. These would include things like copyright, patents, any other ideas, goodwill. These are called intangible assets. They're non-current assets without a physical presence, cannot be physically touched. They provide exclusive rights or privileges. They're usually acquired for operational use, and they have a useful life that is oftentimes difficult to determine. Usually the useful life is determined by the patent office. For example, a patent might last for 20 years. A copyright might last for 5 years. That's usually what we call its useful life. They're recorded at the cost plus which is the purchase price plus legal fees and filing fees. That's the acquisition cost for a intangible asset. Intangible assets include things like patents, copyrights, franchise licensing fees, trademarks, goodwill, rights of use, leasehold improvements, research and development, and other intangible assets. Things you cannot physically touch. Of course, a couple of ratios. One is called the total asset turnover ratio. We take the sales divided by average total assets. Average total assets, we take the beginning of the year total assets plus end of year total assets divided by 2. Provides information about the company's efficiency of using their assets. In this case, the higher the total asset turnover, the better. Sometimes there might be an exchange of property, plant, and equipment for other property, plant, and equipment, just like almost like an even exchange or close to an even exchange. There also might be trade-in allowances and things like that as an exchange for property, plant, and equipment. It's just good for you to know that that type of thing happens from time to time. It's kind of like doing a trade with somebody, one asset for another. And when that happens, we do need to record that type of exchange. And so the way we do that is we identify the market value, we record its book value, plus or minus any cash that has also changed hands to find either a gain or a loss. I just walk through the journal entry for something like that. Okay. Any comments, questions, or concerns as it relates to depreciation or anything else with property, plant, and equipment, or intangible assets or natural assets?
Not at the moment.
I'm
Awesome.
just glad you recorded the sessions.
Yeah.
I'm gonna have to go back and review everything again and again.
Yeah, I appreciate that, Nick. Yeah, it's a lot. It's a lot of information at once, and that's why I do record these sessions, and it can be complex for sure.
Definitely a lot of information at one time. You know, I mean, I sit here, I listen, I'm trying to retain as much information as physically possible, but it takes me more practical application and more, you know, really reading it and going over it again just to make me kind of understand it.
Exactly, yeah, and that's why it's also good to work through those example problems as well, right? So, um, as I had mentioned at toward the beginning of this course, we have exercises. So what I started to do for module 3 is you'll notice that I started to include the exercises in the folder for the each chapter. So for example, we just got done with chapter 10. So if you go into chapter 10 exercises, you'll find a couple of examples to work through. And so what this does is it will help you to identify, using hands-on experience, some of the things we just worked through. For example, if we look at, we'll say, depreciation tables, you're like, oh, I kind of get it, but kind of don't get the depreciation. You can look at this file, so you can download the file. This is an Excel document, it'll open up like this. And you can work through the questions, right? So here we have a problem. It talks about a robot. You can select what type of depreciation method to use, either straight line or double declining balance. So if we use straight line, what's its useful life in number of years? We can figure out this type of thing, yes? So if it's 5 years, what was the first month of use? We'll say it was January. We can populate, this field. Let's say its cost was 30,000. It has a salvage value of 1,000. It helps us to populate the depreciation for each year, right? This is more like what do you call a template to help you to understand the application of the depreciation methods. So here we have double declining balance. We can use that same information and you see how it changes, right? So it's cool. These are good ways for you to gain a better understanding as to work through some of these. They're all the exercises are there to help you to conceptualize and apply what you're learning. But I'm glad that you brought that up, Nick.
Yes, sir. Thank you.
Absolutely, my pleasure. Are there any other comments, questions, or concerns? Okay. As a reminder, you have the Chapter 9 homework assignment, Chapter 10 quiz. Both are due this Sunday night. I recommend that you work early. Definitely use class time on Thursday to complete Chapter 9 homework assignment, Chapter 10 quiz. This will help you from falling behind. We don't want to fall behind because that gets very risky in an 8-week course, especially since we only have 3 weeks left, right? So, okay. If you need anything, you can email me, call me, set up office hours. I'm here for you. Always reach out to me anytime that you feel that you need the help. I am here for you. So I just want you to know that. And with that, I hope you have a wonderful rest of your day. Stay safe, wash your hands, do the right things. I'll see you all again next Tuesday. Thank you so much for your time today. Appreciate all of you. Have a wonderful day.